Hey guys, Dave Keller here with Market Misbehavior. One of my recent videos, I was asked about the duration of technical signals, particularly price patterns. How long are certain patterns relevant, and is there a certain time frame where they make sense? Today, we'll talk about an ideal time frame for price patterns. So I'm often asked about price patterns, trend lines, support and resistance levels in particular, and asked about duration, right? How important is a level that happened 3 months ago or 3 years ago or even 3 decades ago? So the short answer to that question is it depends, right? It depends on the particular chart, what time frame you're looking on, and what your investment horizon is, right? What your intentions are of using that chart. But I'll show you an example with Netflix and another one, LRCX, just a basic ideas, general principles that I think make sense when you're trying to analyze price patterns, and make sure with support and resistance levels in particular that you're using the most important levels. Having said that, if you like this sort of thinking about technical analysis, behavioral finance, investment decision-making, if you like all that, won't you subscribe to my channel? It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. What do you see next for Netflix and LRCX, the two stocks we're featuring here today? Let me know in the comments. Let's get to the charts. Okay, so here we're looking at the chart of Netflix, and as we can generally see, there's been this rotation from accumulation phase in much of 2021, a distribution phase for really the end of 2021, first half of 2022, and then back to an accumulation phase really with higher highs and higher lows. Now, Netflix has been on my radar because after making a double bottom in May and June, it broke above this swing high here in early June, broke above there in mid-July. So Charles Dow taught us in the early 1900s that a downtrend is a series of lower lows and lower highs, and an uptrend is a pattern of higher highs and higher lows. So when the lows stop getting lower and when the highs stop going lower and start going higher, that change from lower highs, lower lows to higher highs, higher lows, that is the rotation that he was talking about. Now, there are a lot of more sophisticated ways to analyze price behavior and a lot of ways to confirm what I just said. For example, getting above the 50-day moving average, the momentum characteristics, getting to more of a bullish range, all of those things would, serve to validate what Charles Dow taught us. But again, it always comes back to that basic premise of, is a chart going up or down? And that one basic piece of analysis should be, in my opinion, the foundation of all your technical work after that. Having said that, I get asked a lot about how significant certain levels might be, right? What levels, how do you know what levels are important and what levels aren't? And I'm asked about it with a lot of different things, with divergences, what time frame makes sense, with support and resistance levels, what time frame makes sense, with price patterns like head and shoulders patterns. And so here's the general way that I would describe it, right? There are certain things that have an ideal time frame, and I'll talk about a head and shoulders pattern here in a few minutes using an example, LRCX, because it has a great example of a pattern that is not an inverted head and shoulders, but I think some people would probably try to label it as such. Having said that, a lot of times it makes sense relative to the time frame you're thinking about. So my default chart that I use on StockCharts.com is a 2-year daily chart. And I do that time frame because my usual goal, although I like to look short term and I like to look super long term, depending on what I'm trying to do, my main basic, what do you think of this chart kind of question, and I just want to bring something up and see where it stands, I'd bring up a 2-year daily chart. The reason is because I'm usually looking a couple weeks to a couple months down the road. And so by looking at 2 years of data, I have a pretty good assessment of where things have come from. I have a good sense of key levels on that time frame. And I have an idea of what is most likely coming next. And now a point I just made there is important, which is the levels that are important on my time frame. So if I'm looking at, if I'm a swing trader, or if I'm a day trader and I'm looking at Netflix on a 5-minute chart, certain levels may be completely different, right? I might be keying in on particular price points because on that short-term time frame, I'm seeing order flow come in, I'm seeing activity at different levels, and I can make some assumptions there. As a medium-term, long-term investor, I'm more looking at the trends over time. And so for me, I'm always trying to focus on levels that I think the average investor who uses a chart would probably be looking at. And to be honest with you, I think it doesn't have to be super scripted. I think it actually can be fairly subjective as long as you know what you're looking for. And here's what I would tell you. Always start with the current price bar. My show on StockCharts TV is called The Final Bar, because what I always tell people is start with the final bar and then look to the left. Start where we're at and look left to see where we've come from, right? So where we at right now, Netflix at the time we're doing this video, decent day, up about 7.5%, up to just above 288. This after a pretty good earnings release this week. Positive subscriber change, which is pretty encouraging. So a gap higher on Wednesday, powering above the 200-day moving average today so far intraday. But look to the left and see where we're at relative to where we've been. You can see that 250 was an important level in August and September and October. We bumped up against there a number of different times. And as always, the more that you test a particular level, the more that something becomes important, or the more that something is validated by a retest, the more important it becomes. What other levels have been important recently? Well, I would say this level right here, sort of 215 or so, 220, which was the low in September, and the springboard there in mid-October before the rally that we saw. Before that, it was sort of a similar level here. This is where 210 was where we got up in early June, and below there you have support around 165, 170. That was the low from May and the retest in June. How important is this level back here? Because as we're breaking higher, it's like, well, what's next? So again, what I would always say is look to the left. You have to get through a lot of stuff to get back to some of these levels back here. So I would argue none of these levels really are super meaningful, except for ultimate highs and lows, extreme highs and lows, right? The highest level we've ever been, that tends to be pretty significant, because no matter what time frame you're looking at, if you zoom out and see this big high that we've never eclipsed, that's when people very logically and rationally look at that and think, okay, is there enough gas in the tank to propel Netflix above 700, for example, and go to new all-time highs? That's the question that tends to come up for a significant level. So to be honest with you, look back over time. What levels stick out at you? The all-time high here around 700, absolutely. The low here around 165, 170, absolutely. The most recent breakout level around 250, absolutely. Maybe as we go higher, some of these levels back here, right, like 400, right, which is a level that we consolidated around in the first quarter, spent quite a bit of time there. I think that could be important. Anything to the left of that all-time high, I would argue, probably not at all, kind of even a little bit important. And the thing, and again, I think what you always want to remember is start at the final bar and then go to the left. What levels stick out? What levels have been tested multiple times? Draw a series of lines there. So the way I tend to look at a chart like this is I usually start with horizontal lines and just start picking them out. I'm making them garishly wide just so you see them. But, you know, and maybe I do one there, kind of hitting that level. I probably do one here around 250 because that's there. Probably put one here because that's where we topped out around 400, certainly at the all-time high. Now, again, not that all these levels are equally important, or not that all of them, I think, will come into play, but it just gets me thinking about where we've been, where we're at right now relative to where we've been. It just gets me a sense of where we're at relative to this framework that I'm thinking about. So having said that, right, a lot of times I will get people that draw trend lines. And, you know, so if I take Netflix and go back like 12 years, right? This is going back to here, and you might draw some big long-term trend line from like there to here. And you say, obviously, a big trend line break and then a failure. Is that a technically valid way to draw a trend line? Of course it is. I can't disagree with that. Is it, you know, the perfect trend line because it's been tested a bunch of times? No. But I would argue, like, if the price rallies, is that trend line going to have anything to do with where we're at right now? I don't think so. And I think a lot of times when you draw really long-term trend lines, it's more to validate something else that you've already found, and you're trying to find some additional evidence. It's probably a form of confirmation bias more than anything. Having said that, looking at like monthly and quarterly charts and looking at long-term trends, I think that could certainly make sense. And if you use this not as a technical trading tool, but more of a way to visually represent the fact that Netflix had been going up and now it's not going up anymore, I think that's totally fair. I think that's a great visual way to represent a change in trend. Is it a valid technical approach? Meaning if the price rallies up to that line 8-9 months from now, what I say, obviously we're going to have resistance there because it's that big trend line. I can't acknowledge that that would be a meaningful line, you know, right? And so again, if you have to draw in a ton more data and draw some crazy stuff to get the line to work, what are the chances that one other person is going to do that and come to the same conclusion? I would argue minimal. So one other comment that I would make is I sort of stream of consciousness about best practices of drawing lines and identifying levels. You know, LRCX is a stock that's in the news this week, bouncing up pretty well. It's up another 3% here so far on Friday after bottoming out around 360 points, another 20% gain off of the lows in the last week and a half. Not bad for a key name in the semiconductor space, a group which has certainly been struggling recently. However, this is what I get. I actually had a question on this, and someone asked me, and this was a while ago, this is back when it was actually happening, but they looked at this point right here and said, is that an inverted head and shoulders, right? And an inverted head and shoulders pattern is a low surrounded by higher lows. And their comment was, isn't that a great continuation signal because if we had a big rally, then an inverted head and shoulders. So on this time frame, looking at multiple years, there's no way that could be labeled an inverted head and shoulders pattern because it's so small relative to the time frame that I'm thinking of. If you go back to Edwards and McGee, the Bible of technical analysis, and really one of the best resources still on traditional price patterns, or look at John Murphy or Martin Pring or any of their work, they will tell you that a head and shoulders pattern is a multi-month pattern, right? The ideal pattern takes months to form and months to conclude. There's a volume component, which is very important. So to be honest with you, humans are hardwired to find patterns. As a result, we often find patterns that I would argue really aren't those patterns. And we often, it's called wishful thinking analysis. We want something so desperately to be a certain pattern that we can almost see it with our eyes, right? I mean, it jumps off the page, but a lot of times those are not super valid. I would stick with the best practices, meaning something like a head and shoulders pattern should take months to conclude on a daily chart. It should not just be like a day-to-day, week-to-week thing. These are big, broader patterns. I would argue, head and shoulders patterns on, 1 minute charts. And maybe, but that's certainly not the way I've ever thought of it. I don't think that that's how the market evolves on that time frame. The head and shoulders pattern is a particular pattern for long-term and medium-term investors thinking about structural changes, and it's aligned with Dow theory and really Elliott wave theory is related in a strange way. So that, I guess, would be my conclusion. What levels are important? It's the levels that jump out at you if you start at the final bar and look to the left. Picking out some level way back here that is no longer a level that a lot of investors are paying attention to, I would argue pretty irrelevant. I wouldn't look any further past extreme highs or lows. That's the memory. That is the recent memory that investors have in their head as they're actually trading these stocks. So on a chart like LRCX, what levels jump out? It's 400, which was the swing high in October. It's 520, this level that sticks out in May and August. Other levels back here, I would argue, are really super not relevant. Also be cautious, I would say, as you're looking at patterns. Remember, they often have a time frame and sometimes a volume component. Head and shoulders patterns are one I often find people popping out. Divergences on really tiny time frames. So they'll like see this little thing and say, oh, this is not a divergence. And I don't think so, because it's more about the time frame that you're looking at. For me, on a 2-year daily chart, patterns that I'm looking at should take a month or two, right? A couple of weeks at least to form to really be a valid pattern. Anything shorter than that, I'm trying to force something out of the chart that may not actually be there. So there you go. This ended up being a somewhat long-winded answer to a question that I received in a couple of videos talking about the time component, right? What's the important time duration to pay attention to? The best practices I shared with you are really driven on my time frame, which is looking medium term to longer term. I tend to look out a couple of weeks to a couple of months. And as a result, those are the levels and patterns on the chart examples I showed you that I'm looking at. If you're a shorter term investor, you certainly could find shorter term levels and shorter term patterns. Just make sure that your charts and your analysis fit in line with the questions you are trying to answer as an investor, as a trader, right? What game are you trying to win? On what time frame? Make sure your charts and your analysis are aligned with that. I'm Dave Keller with Market Misbehavior. Have a good one. We'll see you again soon.